Every major economic shift creates two groups of people. There are those who panic and lose everything, and those who quietly become rich. History doesn't always repeat itself, but it definitely rhymes. Think back to the housing crash survivors, the inflation-era investors of the 70s, the tech boom opportunists, and the people who saw stock market crashes as a clearance sale. Why did ordinary people become wealthy during periods of total chaos, while everyone else struggled to keep their heads above water? Today, we will break down the exact behaviors average people used before retirement to quietly build millionaire-level wealth during the last big economic shift. There is a specific, almost boring strategy that historically outperformed flashy investing every single time. It involves a surprising middle-class advantage that most people overlook because they are too busy looking at the red numbers on their screens. If you want to understand how the next generation of wealth is being formed right now, you need to see the pattern that everyone else is missing. Wealth explosions almost never happen when the economy is perfectly stable. They happen during the friction points: recessions, high inflation, market crashes, technological shifts, or real estate collapses. Consider the 2008 housing crash, the dot-com bubble of the early 2000s, the stagflation of the 1970s, or even the massive wealth transfer during the COVID era. During each of these moments, the headlines were filled with fear. People were pulling their money out of the markets and hunkering down. Yet the people who ended up as millionaires a decade later weren't necessarily luckier or smarter than you. They simply followed repeatable wealth-building strategies while the rest of the world froze emotionally. They recognized that the greatest opportunities are often wrapped in the ugliest packaging. The first habit they practiced sounds completely wrong during a crisis, but historically, it has created the biggest winners in the financial world. That first strategy is simple but incredibly difficult to execute. They kept buying when everyone else stopped. This is the core of dollar-cost averaging during a major downturn. When the market is dropping 10, 20, or 30%, the natural human instinct is to stop the bleeding and wait for things to calm down. But future millionaires understood that investing during a recession is like buying your future freedom at a massive discount. Think about the people who kept their automatic contributions going into index funds during the 2008 financial crisis. While their portfolios looked terrifying in the short term, they were accumulating more shares for every dollar invested. When the market eventually recovered, those shares didn't just regain their value, they multiplied it. The same thing happened to those who had the courage to buy quality assets during the 2020 crash. It is emotionally exhausting to ignore the news of layoffs and global uncertainty, but millionaires treat the market like a grocery store. When the price of high-quality assets goes down, they don't run out of the store screaming, they fill their carts. Someone who consistently invests during a crash will almost always outperform the person who waits for certainty, because by the time certainty arrives, the low prices are long gone. The second strategy involves a fundamental shift in mindset. They owned assets, not just income. Most people are taught to focus on their salary, but millionaires realize that a high income alone rarely leads to true wealth. They focused on owning appreciating assets like stocks, private businesses, rental properties, digital real estate, and intellectual property. Inflation is a silent killer for people who only save cash, but it can actually be a massive tailwind for people who own assets. If the price of everything goes up, the value of the things you own tends to go up along with it. Many high earners stay broke because they are stuck in the trap of trading time for money. They might make $250,000 a year, but if they stop working, the money stops coming in. The people who quietly pulled ahead during the last economic shift were the ones who used their income to buy things that work for them while they sleep. This shift from being a consumer to being an owner is where the real middle-class advantage lies. This leads directly into the third strategy. They lived significantly below their status during the good years. Many people who became millionaires before retirement looked completely normal to their neighbors. They didn't drive the newest cars, they didn't live in oversized homes that stretched their budget to the limit, and they avoided luxury debt at all costs. While their peers were using every pay raise to upgrade their lifestyle, these future millionaires were building cash reserves. Those reserves are what allowed them to seize opportunities when the economy eventually shifted. Imagine two coworkers both earning $100,000 a year. The first coworker spends every dime to look successful, driving a leased luxury SUV and wearing designer clothes. The second coworker lives in a modest home, drives an older car, and saves 30% of their income. When a crisis hits and the stock market or real estate market drops by 30%, the first coworker is terrified of losing their job because they have no margin for error. The second coworker, however, has the cash and the emotional stability to buy the very assets the first coworker is forced to sell. 10 years later, the difference in their net worth isn't just a few $1,000s, it is the difference between struggling to retire and being a multimillionaire. Most people think becoming wealthy before retirement requires an extraordinary income or a stroke of lightning-fast luck. But the next strategy proves that timing and behavior matter significantly more than the size of your paycheck. Before we get into how crises create new business empires, think about this. Which economic shift do you think created the most millionaires? Was it the rise of the internet, the recovery after 2008, or perhaps the recent shift in the global workforce? Let us know in the comments, because your perspective on history usually dictates how you handle your future. The lessons of the past are staring us in the face, but only a small percentage of people will actually apply them. The fourth strategy is that these individuals used crises to change their career paths or start new businesses. Economic disruptions are like a giant reset button for the marketplace. They create openings that didn't exist when things were stable. Think about the internet boom or the recent explosion in remote work and artificial intelligence. Many millionaires didn't get rich by doing the same thing for 40 years. They saw a shift in the world and positioned themselves in front of it. They started side hustles that solved new problems, launched small consulting firms, or invested in real estate when others were sprinting away from it. While fear causes the majority of the population to retreat into safety, opportunity seekers move early. They realize that when the old way of doing things breaks, a new, more profitable way is being born. This is how you achieve financial independence, by being useful in a way that the current economy demands. The fifth strategy, and perhaps the most important one, had nothing to do with money itself. They controlled their emotions better than everyone else. Building wealth during a period of uncertainty is 90% psychological. The headlines are designed to trigger a fight-or-flight response. When you see your retirement account drop in value, the lizard brain wants to sell everything and hide. Millionaires have trained themselves to stay patient and ignore the noise. They understand the power of long-term compounding. They know that a market crash is just a temporary dip in a long-term upward trend. They don't engage in doom spending or panic selling. Instead, they stay the course. Short-term fear is the greatest enemy of long-term wealth. If you can stay calm when everyone else is losing their minds, you have a massive competitive advantage. Right now, we are seeing some of the same conditions reappear. Inflation is high, technology is shifting rapidly through automation and AI, and the housing market feels unreachable for many. While these modern parallels can be scary, history shows they are also the breeding ground for the next generation of millionaires. This isn't financial advice, but rather an observation of historical patterns. What assets or skills are being undervalued today? Where is the fear the highest? That is usually where the opportunity is hiding. You still have time to position yourself, but you have to shift your perspective from fear to possibility. Few want to hear the final takeaway. Riches were accumulated patiently, then looked sudden. Over decades, retired millionaires compounded their investments, survived downturns, and adapted to change. Their development was hidden for years. They saved money and bought dull index funds or modest rentals. However, compounding hit a peak, accelerating their riches. Learning to use uncertainty is the biggest shift opportunity. Perhaps another huge wealth shift is underway. But the question is whether you'll notice it in time. Wealth is for the prepared, not the fortuitous. History provided the map. Just follow it. Which of these historical events surprised you the most? Leave a comment below to help others in our community. Like this video, subscribe to the channel, and hit the notification bell to never miss our next wealth building breakdown in this changing economy, and to help this video reach others needing financial advice. Your future self depends on your choices today.